So let's bring them on and see if we can get into their minds a little bit and see what they have in store for us. So let's welcome Marc and the rest of the panelists. Thank you very much.
Yeah, good afternoon, everybody. It's a pleasure to be here. Thanks also for the organizers, and thank you for being still here. I don't know if there's beer yet, otherwise maybe we would see a little bit less people here. It's a big pleasure for me to host this panel, similar to last year, about investing in the space. And I'm very happy to have some of the leading people behind venture investing in crypto here on stage. And to kick the whole thing off, I would suggest maybe to start with a very brief introduction, including also your investment thesis. So ultimately, what's driving you to invest in blockchain companies?
Sure, and thank you. And it's wonderful to be here. My name is Dave Long. I'm head of investments at CVVC, so Crypto Valley Venture Capital. Some of you may be familiar with that. Some of you may also be familiar with our sister company, which is CV Labs. So that runs our ecosystem at headquarters, which is here in the heart of Crypto Valley. We also have offices in Berlin, in Lisbon, Vaduz, Cape Town, and we're looking to expand to Southeast Asia this year. As far as our thesis, we're pretty broad. So if there is blockchain technology that's within the tech stack, we invest across industries, but we are still early stage. So through our first fund, which we launched in 2020, we've made 59 investments across 21 countries, 4 continents, and 12 different industries. So early being, we're investing from pre-seed through our acceleration program, which is run by CV Labs, and up to Series A, and we write tickets anywhere from 135,000 out of our accelerator up to 500,000.
That was a good pitch.
Perfect, thanks. Yeah, I'm Dominic. I'm based out of Germany. That's where we founded Blockwall. We're now based mainly in Frankfurt, but we have a partner in Paris as well and someone in Munich. But as Corona has shown us, we're all about and everywhere at the same time. We have started with the first crypto fund in Germany. We started investing in 2018 out of that fund, which is coming to an end now. That was mainly focused on protocol investments, the up-and-coming projects at that time. Now we have closed a new fund last year, which is mainly focused on venture capital investments, so mainly equity investments in the space, pre-seed and seed. Also very general approach focused on Web3, but we specifically look at the service companies which are necessary for the ecosystem to thrive, or at the technology as a sort of back-end revolution. So looking at where blockchain really makes sense to find new applications. And yeah, we're setting out to build a platform, moving to fund of fund as well next year, and also into late stage in the future.
Hi, I'm Diana, partner at 1KX. 1KX was founded in 2017 and was probably the first of the token funds. So we are focused on investing in decentralized token networks with a thesis that really the aim of blockchain technology is to replace trust with math and code, and that's enabling the decentralized future, essentially. We have a portfolio now of more than 80 projects across the space and continue to invest actively out of that single fund.
Hi, I'm Luke. I'm a partner at Exchange. I am actually quite new to this side of the table, the dark side of the force, because for 10 years I was an entrepreneur. I started a few companies. The last one in date is called Ariani, which we started in late 2017, doing NFTs for luxury brands. For the first 3 years, we were told we're crazy, and for the last couple of years, the business been booming, NFTs and luxury brands all of a sudden make sense. So to date we raised 30 million euros with Ariani, work with over 80 brands like Lacoste, the Richemont Group, Breitling, Audemars Piguet, Montclair, and many others. So what happened last summer? I abandoned my 4 co-founders and led them with the startup, which is doing very well, and decided to do something that I really felt was lacking or where I think there is a shortcoming. I think we'll probably agree on that. There's a lack of funding in Europe with VC funds, and really wanted to launch a fund and help this ecosystem. So I joined Xange, which is a 20-year-old general venture fund, 650 million under management, which has some experience in crypto. We have one of the big things we did was be the first fund to invest in Ledger in 2014, which was a great investment, but never really had a dedicated practice. And so I'm managing a smaller fund, a 60 million euro fund that invests in early stage seed, Series A, tickets between 500K and 5 million into projects mainly based in Europe. We are based between Paris and Berlin, with also a presence in Munich. And when it comes to our investment thesis, we, of course, like everybody, love infrastructure, but we also think that there are needs for applications. Real-world assets and DeFi is, of course, something that we're passionate about. And when it comes to more Web3 applications, things in the continuity of what we did at what I was doing at Ariane, meaning how do you use the on-chain social graph to create new experiences between customers and the brands that produces the products they love.
Hi everybody, I'm Olivier, I'm the GP at Laser Digital Venture. So Laser Digital is the crypto arm of Nomura, a global bank headquartered in Tokyo. And Laser Digital has been set up really as the unit that will look after our strategy for the bank related to crypto and digital assets. So we have 3 businesses there. We have a trading and market making arm. We have an asset management vertical and the venture. And on the venture, we look at investments in early stage to Series A and really projects that are trying to solve for the pain points related to institutional adoption, because that's what we're going through ourselves. So we do check size as low as 250K, as high as 20 million. We have a large amount of flexibility given the fund currently is captive from Nomura. We're going to bring in third-party capital at some point, and we invest globally. We've done already 12 projects, and before that, we're investing out of Nomura's balance sheet in a lot of infrastructure type of project.
Yeah, thanks a lot for the insights. And I mean, to follow up, quite a few on stage here are in the space in several years, so we saw many of the developments. And I think something which is always interesting for also the audience here is to make the whole thing more tangible. So can you maybe, everybody of you, give you, the audience, one concrete example of a company you're invested in which is also really solving a real-world problem? Because I think that's always something many people are still missing in the space. I mean, whoever want to go first?
We invested in a seed stage company, UK-based entity. However, they're solving, or the team is in Nigeria. So their main focus is being a crypto exchange, but offering also innovative financial products for the local community. So be it lending, be it other financial services, and also remittances. And that was really interesting to see also in this crypto winter that there was no sign of lesser use. Rather, the users have grown constantly, revenues have grown constantly. So there are roughly about 4 million in revenues at the moment, above 500,000 users. It's a pre-Series A company, and they're just expanding to Kenya and other markets. They have now just entered and gained a license in Poland with the goal to bridge that remittancy gap between Europe and Africa. And there you really see, okay, if it's needed, if it's usable, then the users will come automatically, and it will be resistant to any downsides in the market.
Yeah, unrelated to the cycle, yeah.
Very interesting that you guys are focused on Africa, because that's a big topic, or that you have, that there is a focus in addition to everything else, because that's a big focus for us as well. But one company that I think is quite interesting, and it's a fun one-liner to use, but just what many people may not know is that in the cars that we have today, in the technology, you're operating more lines of code than a fighter pilot operates in a fighter jet. And all the over-the-air updates to that software that exists in the vehicles and the technology in the cars today is done over the air. And so how do you really secure that? So one of the companies that we invested in, I think back in 2019 even, from Germany, a company is called Ashwin. They use blockchain technology to make sure that IoT updates over the air are done securely so that there is nothing that's tampered with. And that's beyond just the example of a car use. But for us, we've always said that we invest in utility over speculation. And that's investing in companies that are using blockchain technology to solve enterprise problems and create real-world application.
Interesting.
It's a good question, actually, the one you're asking. So we have one company in the portfolio we invested in 2019 in the Series A, based in Hong Kong. They are at the intersection of digital asset and green finance. And so they do tokenization of kind of project in the green space, such as a solar farm or wind farm. And by tokenizing the kind of the bond or the loan, you can kind of have more distribution of the token throughout a broader investor base. But also what was very interesting is that they are embedding a small piece of code in the smart meter or the IoT device of the solar plant, and through that you measure in real time the ESG performance of the asset. And then you can flex the yield of a bond or create renewable energy certificate on the back of the performance of a green asset, which hopefully helps solve for some of the main challenge in green finance, which is the accuracy of data. There's a lot of fake data floating around, or the auditors have to come 1 year after and then report something that is a bit dated. So through that, we're hoping it provides a bit more real-time visibility on the performance of some of those green assets.
Well, the green asset, I'll continue. We just made an investment in a company that tokenizes rights to pollute, so carbon credits, but the mandatory carbon credits. When you hear about carbon credits today, you mainly hear about the voluntary market, which is more of a nice to have, but it's not really a liquid asset. It's actually not really something you can invest in. It's more of I'm making a contribution and I'm happy to show it. But it's not really an asset that can be traded. The carbon market is actually a localized market. The rights to pollute is a mandatory market that is localized in different locations. The biggest one, of course, is Europe, but you have a big one in California and Massachusetts, and actually a big one is being built now in China. The idea here is to use tokenization to give access to a bunch of people that actually want to invest in something that is a liquid asset that does contribute to reducing carbon by putting a higher price on this carbon. Tokenization in that aspect really helps giving access to a wider group of investors.
I always like this question because it makes me really think about my life and think, am I online too much? Because what do they mean by real world? Because the real world really is the digital world to me. So I'm not really sure where,
didn't say offline world.
Where that
Could
line
be also
was.
your real world.
Is there an offline world? Like, isn't everything connected today? But yeah, well, one example from our portfolio would be Liquidity. So you can put ETH down and get out interest-free loans, and we've seen people using that to buy cars, essentially doing their own setup there for a car loan, even for mortgages. I'm actually personally looking into using this now in order to get be able to take out a mortgage using ETH on the platform, because actually the rates in the real world aren't great right now, and you can get liquidity through that platform. Also, if you don't have a sort of standard job or tend to live in one country, I think it fits pretty well for people in our space, then you can actually be banked through these crypto solutions when the traditional finance world just doesn't have anything to offer you right now, which is continually surprising to me, because even as someone who is a former senior director at a financial institution, to not actually be able to get access to a mortgage, like that's a pretty first world problem to have too. And then you think of how much broader that use case can go, and actually how many people are affected by not being able to have access to traditional financial services, even really basic offerings, if there are certain things about their profiles that are atypical, which I think is just sort of one step and look into the breadth of potential that we really have with adding this additional transparency and access through decentralized finance.
Yeah, and I think it's great to have these examples. and unrelated to the definition of the real world, right? So maybe because the topic is inside the minds of blockchain VCs, right? I think something which is also interesting for the audience is the whole situation we're in right now, right? On the one side, I mean, you're investing, but as a fund GP or founder, you're also getting money from investors. I mean, what would you say at the moment? What's the sentiment, let's say, from both perspectives? I mean, as we all know, the valuations are in favor of people investing money, but on the other side, maybe we are again in a cycle where it's difficult to explain in an understandable way to potential investors what you're really doing, and they ask for these cases you just visualized. So what would you say from your individual perspective in your mind at the moment? I mean, what's the cycle we're in right now?
Sure. So starting with the investor's perspective first, I think what was interesting is that the numbers when they came out for the totals that flowed into blockchain VC in 2022 was actually higher than 2021. However, now we're seeing that the reality of what has happened in the financial markets globally, we're not on par. And there's about it's on par at the end of this year, we're going to be 60% down. But the inflows that we have seen have been for a number of different reasons. And if you look at the last 5 years, there's been a lot that has changed in traditional finance, which caused these inflows to go into private equity and venture capital. That 60-40 portfolio that institutions have run for many, many years now, that simply didn't work. You had issues in the credit markets, you had issues with volatility, but as taking it back to raising funds, I mean, it's definitely more challenging, but you need to have a niche. There needs to be a specific focus. I mentioned that for us, Africa is one because we think that blockchain technology is very powerful there, which is getting a lot of the attention from LPs out there. On the fundraising side for founders, the average or the median value of that is going into companies, that is actually increased, but the valuations, of course, decreased, meaning founders at an early stage it can still raise funds, but they have to be prepared that they're going to have to give up more equity than they would have in the past, which maybe safe notes or CLAs that might play in better depending on the situation that any founders are in currently.
Yeah, I think you always have to look at you basically have two types of customers. One are your investors, one are your founders. And the investor side, it really depends on how professionally they build their own portfolio construction. So some investors, if they're highly professional, they particularly choose you for a certain risk-return profile, for a certain vintage, for a certain part of the market they want to cover. So actually, if you're not deploying in that certain vintages, if you're not taking enough risk, then you're not delivering to the promise to the investor who has specifically chosen you to cover a certain risk-return aspect. On the other side, of course, it doesn't make sense to just deploy if the quality isn't there or the market is overpriced. So what we're seeing on the deal side is that actually the more quality founders are coming back to market, but we see lesser quantity of deal flow. Valuations have decreased massively, but also not yet fully accounted for in the reporting on the late stage side. It's funny that on the early stage side, yes, valuations have decreased, but those really competitive rounds, I have the feeling that valuation has even slightly increased, choosing higher caps with CLAs. And what we always advise our founders is don't raise too much. You will risk kind of ending up into a down round scenario maybe in the future. Raise for enough runway. Like an absolute no-go would be someone who raises less than 18 months in the current market environment. Even 24 months, I would say, should be the minimum. Just because you don't know when you're able to go back to market. Take enough buffer there. And I would say that is the most important at the moment. And another, I think, effect will be that because already startups have been raising for longer runways, they will come back later to market and then showing even higher KPIs at that next following step. So the expectation of investors will be to have even higher KPIs at Series A, for example, which was at 1 million is moving rather to 2 million ARR at the moment. So the competition will be even higher for those who start.
Yeah, and I think the times where you literally close a funding and are already looking into the next funding round is maybe, at least at this stage, it's a little bit over, right?
Yeah, I would really echo what Dominic said. I think that was all very spot on. Obviously, also like, your treasury management and how you kind of build out and focus for the long term becomes really important. But I think these periods in the market are actually the most interesting time in order to find both investors and the projects that are really aligned with you, with the vision, and in it for the long term. So I think it's very high signal, and it's really, for me personally, I mean, after almost a decade now, these are kind of my favorite periods in the market, because you know that the people are really in it for really what they're building and are able to have that focus, and also for ones that are investing in you, that they understand how the market can go and are more prepared and usually have like thought up and really are committed to the thesis.
Mm-hmm. Definitely.
Yeah, kind of same thing. The fundraising on the LP side, so when funds raise, for sure, the moment is difficult. A lot of institutional investors have put things on hold, and so I need to do my second close next year, and definitely it's much harder than it was last year. So it's, but the question is, when is it going to thaw, when it's actually going to start again? Don't know. What we see, though, compared to all the people I know in more like traditional, not traditional, but generalist VCs, is that it's actually easier for us to raise with a specific strategy, kind of a dedicated fund, because, of course, a lot of people are kind of on hold, but the people that really want exposure to this specific asset class or this specific kind of projects are looking for good funds, and there is a lack of funds dedicated to this topic in Europe. So it's actually somewhat easier for us. On the other hand, when it comes to investing in startups, well, so I'm going to put my 10 years of entrepreneurship hat back on. The VC market has kind of a sheep mentality, and so when everybody's excited about something, everybody's excited, and things kind of go off and valuations explode, multiples explode, and that's kind of what we had in 2021, 2022. I mean, obviously, now all of a sudden, everybody's kind of scared. One reason is because LPs are also putting things on hold and feel like things have kind of gone too far. And so everybody's kind of locked. And of course, when everybody's scared, because it's a sheep mentality to a certain extent, everybody gets scared. I think we're kind of going beyond this. There's still a lot of good deals. I haven't seen a good project right now that did not raise funds. You can raise money right now. There's still money being deployed at sometimes valuation a bit lower, but it's not on the seed level. For instance, I don't think valuations have gone that much. Later stage, yes, but on the seed level, it's still about the same kind of valuations that you could get 18 months ago.
Just a few smaller points to add. So when we speak to LPs or like large institutional asset allocator, one challenge that they have right now is that the composition of a portfolio between public and private is very imbalanced, and the public valuation have gone down a lot. The private not so much, because the markdowns from many of the investment they made in PE or VC have not been completely readjusted, and therefore they're very imbalanced. So very cautious, therefore, to deploy into another VC fund where that increase even further the kind of the breakdown of the split between public and private. So for large institutional LPs, that's one concern. When you speak to family office and guys like that, it's very different. Here they look much more longer term at the absolute return, but for like those kind of sovereign wealth fund or pension fund or insurance companies, the type of people we want to attract into the ecosystem, that's one of the pushbacks sometimes we get. When it comes to deploying capital, I think it's a fantastic time right now. There's, you don't need to rush in signing term sheet in 48 hours. You have time to do proper due diligence. Funders are a bit more realistic, but I would echo all the points around, good project get funded, and the ship mentality, I completely agree. I mean, you have a good project, and then suddenly everybody wants to invest, and it's over-allocated, and that's where you start to see also. One other point I would say is, especially on early stage, you start to have, I think, growth funds who are realizing the valuations are, still mispriced on the B or the C round, and so they need to deploy, and they're coming to early stage and Series A, but they have a lot of capital, so suddenly they write, very big check, and valuation gets pumped up, and us, we are looking more at early stage. It's getting then sometimes difficult to make a decision around that. So yeah.
Yeah, thanks for the insight. I mean, I have to add to you, Luc. I mean, that's exactly what I also see, right? That you have these developments that to a certain point, I mean, we have now European allocators here on stage, and I don't think that there are hundreds of people doing similar stuff. If you look into other markets or industries, you have dozens of funds literally doing the same. So as you mentioned, I think there's still the potential versus the money which is available to entrepreneurs and startups in the field is still, I think, far underserved. And I think that's ultimately also maybe the reason why, unrelated to the market, all of you guys here have the opportunity to really take advantage of the next cycle. And maybe to dig a little bit deeper into that, I mean, referring to the happenings of last year, right? I mean, I know you're not in the trading space and also more on the long-term venture side, but what were the biggest changes maybe after you had FTX and some other of these bad happenings where, at least in my view, being in the space now since 11 years, many came back and said, I think that was it now. I always thought you're doing the wrong thing, right? And now again, you have like the Mount Gox for the latecomers. I mean, did you see any, let's say, changes of the perception of allocators or business cases you see? Because some people really thought, okay, now it's again going to a point where some people think it's going away and the technology is maybe not really bringing some value. Or, I mean, you made a good example of companies working without any influence from these happenings. What's your view on that in general? Whoever wants to go first, maybe ladies first once.
Sure. Well, for us, given that we have been focused on investing in decentralized networks, it was really a doubling down on our thesis and the emphasis of really the reason behind this technology, and what we believe in here is to use it to replace this trust that you need in these centralized institutions. So for us, yeah, it was really that reconfirmation, and we have in our portfolio, for example, SAFE, formerly Gnosis SAFE. We co-led their Series A last year, and they are a multi-sig digital asset management platform, custody, self-custody, saw huge inflows. I mean, now they're securing over 40 billion. And that continues to grow. I think it was obviously a big lesson to everyone, firstly from the centralized exchanges in crypto and just how opaque those are and how certain actors are still sort of using the name of crypto, but essentially acting as one would, which is just sort of basic fraud that also happens with the traditional system, to really advocate for this is the reason why we need these transparent systems that are open source, where you can actually audit the code and be able to build on them and to have that transparency and to remove that trust with this technology, which is really at the heart of it. So that was critical. We saw that then later also even with the banks in the banking system in the US. And so I think that was a second wake-up call where we thought, okay, this is sort of what's considered safe and secure and regulated. They also have plenty of issues there that we need to address as well. So really sort of twice over doubling down on the thesis and the emphasis, and we just hope that through further education and actually use of the technology of public blockchains, that will become apparent to regulators, to institutions, of just how it enables exactly what they're looking for in terms of reporting transparency, all in real time.
So it even helped you, literally, the whole bad happenings, right?
I mean, it did not help the space at all, and certainly the attitudes changed across the board, and we've seen things get a lot more difficult overall. but I think for the long term, it sort of put us back into that understanding and awakening and reminder of why we are using the technology and how we need to build it.
Just so fully agree on the DeFi, and it's very positive for DeFi what has happened, last year. But I think on the CeFi and more infrastructure side, we're looking at a very interesting project that are trying to solve the gaps exposed by FTX. So, for example, we're backing a clearinghouse for digital assets. That reduce counterparty risk. That will make in case of a default of one of the members of a clearinghouse, you can mutualize the risk by paying through the insurance fund. So those type of projects, I think, are going also to pop up because DeFi and us on the laser digital side, we're looking at it, but it still is fairly complex to enter as a regulated financial institution for many reasons. And I think it will come, but still to enter the space right now, you need regulated, centralized player, and some of the ones that are popping up right now are also taking an approach that is a bit more like what you see in TradFi. For example, we invested in a electronic communication networks that does only this. It's matching buyer and seller. There's no custody, there's no primary issuance, and therefore all the conflicts of interest are removed, unlike some of the existing platforms that went bust in 2022. And the other thing I would say is a lot of the failures have happened in the US. That makes, I think, the regulatory environment in the US still fairly uncertain. So right now we are a bit cautious around deploying capital in projects in the US for which the potential regulatory impact could be, unclear, at least for us.
Yeah, I think you can learn a lot out of these last 2 years, and I've talked to one of the large investors in FTX at that point, and who was regularly in contact with SBF. And even 4 weeks before it happened, there was no sign really in changing his mindset or in anything else. So there are bad actors in the market. It was definitely a blow for the industry, and we were on such good trajectory. And you just think about, okay, how would have you realized this situation? What could you have done? And I think it's very difficult to say in the end. In pre-seed, seed, if you invest, the only thing you can really take care of is getting to know the founders, reference calls, kind of really looking into the minds also of the founders. And then it's about governance, then it's about AML, it's about really getting certain things done. But I mean, this is part of our job description, is taking risks, but also everywhere where there's a problem, there is an opportunity and a founder who wants to solve it, and that's what makes it so exciting. And to double down on what you said, definitely looking at the real problems, the why founders are working on something, not being the copycat of the 10th exchange or solution, but really solving for critical issues in the industry. That is what we do. And in terms of our investors, what they expect is full transparency, right? The first thing we did when that happened is written a report to all LPs. Yeah, okay, how exposed were we or weren't we? And I think that is the best thing you can do, is be fully open, fully transparent with your LPs. Yeah.
That makes sense.
Well, quickly on FTX. So it was, in 2022 was difficult with the Three Arrows, Celsius, BlockFi, Luna. I mean, there were quite a few things. FTX really hit different, especially because we had some company portfolios that were impacted. Some very positively, like Ledger, who made their best sales right after FTX was announced. Some others that were very negatively impacted, like CoinHouse, which had an earn product similar to the one that that was provided by Genesis, and of course Genesis was impacted by the FTX failure. So that was definitely an issue, because we had to write to our LPs. Like before that, we never really had to talk officially about Luna or all those other issues. And here, FTX, we had to actually say, yeah, there was an impact. So that kind of put it on the radar for our LPs as something that was not just something happening in another space, but really something that was impacting us. And that's why I think FTX really hit differently for us. When it came to really raising money with those LPs, I actually think same thing, it was kind of twofold. The people that were on the fence, kind of like about to FOMO, kind of like, oh no, definitely not going to touch this. That's once again the proof that we were wrong. The people that are, I think I would say, much more connected to the industry were more like, oh, actually this is probably the sign that this industry is getting cleaned up and we can consider an investment. Still an idea of let's wait another few months to see what happens, but still, for some it was a positive thing. It's like, let's get back to more serious stuff, and I think it also showed what, I mean, it reinforced a lot of our investment strategies or thesis, which is on real world assets, things that are a bit more tangible for those LPs, or everything that is non-speculative, meaning like anything that has to do with NFTs from corporates that are not traded, bought and sold, but more for customer loyalties or other applications.
David, do you want to add something?
Just very quickly, something that Luc, that you said earlier when you were mentioning the sheep mentality. There was a lot of projects or a lot of hype that was spinning around the market before some of the negative things happened. But even with that, and I believe that for the long run, even though there was significant amount of pain in the short term, it's actually going to help our industry. We're still seeing adoption that is increasing. Use cases are increasing, and I think that when it's our parents that are using it on a daily basis, but not understanding technically how it functions the same way that they would put down the internet and the use of email back in the late 90s or 90s and late 90s, early 2000s. I mean, look at it today. It functions every aspect of our life. So, I mean, we have to be bullish on it. So I think that it cleaned up our space for the better.
Yeah, maybe a last question before we opening up to the audience. I mean, maybe briefly your perspective. I mean, outlook, also from a, let's say, VC perspective, do you see any specific topics which are maybe not yet known to everybody, or some fields where you think you want to double down or have a closer look at? So what's happening, let's say, in the next few months in the whole space, without knowing the future, I know.
Sure. So I can say two areas that we're really excited about, and yeah, seeing a lot of activity. Obviously, ZK everything. That's been happening for some time. That it's a growing area of interest. We've just hired actually a new partner, Wei Dai, who is focused on that space, PhD in cryptography. Made a recent investment into Lagrange Labs, which is using ZK tech for interoperability. So there's like a lot of new applications and potential. Also ZK ML, so machine learning model inference using ZK is some recent research that we've just published. So check that out. And we'll be doing a ZK Hacker House at ECC. A second one would be autonomous world, so on-chain gaming. One of our partners just led a weekend in Lisbon with 54 founders, builders across on-chain gaming. This space is really exploding. A lot of really fun and interesting things happening in a kind of new type of primitive for gaming.
So good contrast from ZK to gaming, right?
Shows the breadth of innovation happening across the space.
Yeah. Anybody else wants to share some insights?
Quickly, I think that when we're seeing the areas that are adopting blockchain technology or Web3 technology overall, the fastest is emerging markets. I've mentioned it a couple times, but I think that CVVC is quite excited about what we're going to see out of the emerging markets for blockchain technology. Not as quickly as we will see it in the developed world, simply because quality of life, it doesn't require the innovation as quickly as it does in some of these other areas.
Right now, we're quite bullish on real-world asset tokenization, and we've talked about that for 5 years. And conferences in 2017, we were already excited about this as an industry. But I think in 2023, we start to see high-quality assets coming on chain, and that's the difference. I think the technology is actually not difficult. RWA is 80% Web 2, 20% Web 3. It's all about finding good quality assets and the governance and the regulatory framework to support that. And then on the back of this, you build the data platform that is required to monitor that, the credit scoring system, the liquidity platform to provide the secondary market. So we got excited around the full value chain linked to RWA.
So our second real-world assets, it's still something we're extremely interested in, and I also think that what we were missing 5 years ago was probably like the DeFi primitives that we now have. This week, I'll add one that I love, which is decentralized identity. I still think, and it goes with zero knowledge. There's some great projects like Sysmo that use zero knowledge to actually manage decentralized identity with badges and other stuff. We're convinced that in order to interact online, we will need to differentiate ourselves from our bots and artificial intelligence, and that comes with a need to be able to show kind of who you are and build a persona online. To be a bit more precise, I'm mainly looking at very verticalized decentralized identity solutions. KYC AML for DeFi, for instance, is a big one that I'm very interested in. Another one is anything that has to do with really your gaming profile on chain is another one that could be interesting. But I'm extremely interested in any other verticalized application of decentralized identity.
Yeah, I think there are many opportunities if you have money to invest now. That is for sure great. The latest investment we've done was in an MEV recovery business. For those who don't know, a maximum extractable value is inefficiencies in platforms, and I think that has only started. And there's a huge opportunity. It's a very niche opportunity, but I think it will have a large impact if you can solve that. And then a completely contrarian opportunity I think is interesting is to see how brands are really realizing, okay, we not only have customers, but we really have communities we have to think about now. And there are many new engagement possibilities within Web3, within gaming, within metaverse and NFTs. So the next frontier of social engagement, this is only starting to trickle down. So I'm looking forward to seeing more projects in that space as well.
Yeah, thanks for the insights. And I would say we use the remaining minutes for some questions for the audience. I don't know, should I pick the guests or, yeah, so let's start with you.
What are the biggest changes you're seeing in terms of deal terms in this environment? What are you able to get now that maybe a year or two ago you weren't?
Whoever wants to go first.
Lower valuations from our perspective.
Right, but so in terms of your term sheet or SAFE or Series A, documents, what kind of terms you're getting that are more investor friendly now?
Well, at least for CVVC, that hasn't changed too much. So there hasn't been anything abnormal that we have changed in our operation, but I don't know about the rest of you.
So investing in CLAs or safes without a discount is, I wouldn't even start discussing that because why would you take a risk as an investor today on a cap, ending up potentially knowing that you'll raise less, end up at the cap, and then having taken the risk 1.5 years earlier. So we accept if the team is exceptional and we know, okay, they will most certainly hit those milestones and there's no way we can negotiate our way in. Otherwise, we would never accept a term sheet without a discount, preferably looking at price rounds anyway. And then what we see, I mean, we haven't done that yet, but what we see is that liquidation preferences have changed slightly. So what was an 1x liquidation preference before is going to maybe 1.5 now. And I think that is a good question, definitely, because valuation is only 50% of a deal term sheet. The topics like liquidation preference and so are equally important.
Yeah, so I hear a lot of people tell me that there's a lot more structure now, meaning liquidation preferences are more difficult. I don't know, for us, and I guess it's the same thing for you, we don't look at it that much, because the truth is those liquidation preferences are not really what make your performance in the end. If you have to trigger a liquidation preference, when you're doing early stage, if you have to trigger a liquidation preference, is that you've already kind of failed your investment, and you're much more, I mean, 99% of your, or 90% of your return comes from like the top 10 performers. So I have to admit that, like you, we haven't seen any changes in how we operate. I hear people say maybe probably in the later stages, because people want to maintain their valuation at the Series C, B, C. You probably have more structure, but the seed and Series A, same thing. I don't really see much changes.
Yeah, maybe to the neighbor.
Yeah, what is the sentiment of the audience towards the deep-in market opportunities in decentralized physical infrastructure networks?
I have no clue, so go first.
So I love the topic. I've loved it for the last 8 years that I've discovered Ethereum. I'm also to date quite disappointed in all the applications that exist to date. It doesn't mean that I think it hasn't been proven yet, unfortunately. Like Helium is a beautiful example that I like to quote. I also like to not talk about the financials too much, because it's about 300K worth of, I mean, their GSM network is about 300K worth of revenue last year, and it's about 30 million of token emission. So there's still a big, and it's, a 7-year-old project now. So I love the idea. I don't feel it's quite mature yet, but I'm a VC. I change my mind all the time, so I hold ideas very strongly until I don't. So of course I'd be happy to be proven wrong and to find something that I'm like, actually, finally the time has come.
Yeah, please.
Reality is metaverse right now. There are lots of exciting projects. We're going to launch our kind of a brand in the metaverse and so on, but it's mostly for PR right now, I feel, and the actual number of users on a daily basis in the large metaverse platform is a fraction of what you see on any online game that teenagers are playing. So I still think there is a lot more that needs to be done to convince a brand to build real experience in the metaverse, at least for us. So we haven't done any deals in that space, and we're still going to remain fairly cautious around the opportunity there.
I think the most important aspect, if you look at building something in the metaverse, choose a roadmap, right? What is working today, in 1 year, in 2 years? How can you monetize on that basis? And then what is the potential outcome in 3, 4, 5? And there's so many bottlenecks which you can't influence, right? It's telco infrastructure, it's devices you need, it's so many different aspects. So you have to think one step at a time. And if we see founders who think that way, who can prove that they can build traction even on that development path, then we're all up for it.
Great. So I think looking at the time, right? Can we add 1 or 2 more questions?
You can add one or two more. Yeah.
Okay, please go ahead.
So in a bull market, you kind of get a sense that everything's a green flag, or there's a lot more projects that get funded. And then in a bear market, it's like everyone's struggling a little bit with the fundraising story. Maybe just from your experience, what are, I guess, the more prevalent sort of red flags now, or what are things that you see startups not doing right, and you're like, only this thing was better, maybe I would consider it. Like easy mistakes that startups can fix.
I think still in too many cases we see very smart founders that take a very product view of what they're building, but the go-to-market strategy remains fairly vague beyond statements around I'll build a community or build a network and I'll make revenue on the back of it. So we like to see as much as possible, not necessarily a detailed business case, it's hard in the seed, but like some solid thoughts around the monetization.
Well, quickly, I said that yesterday. as VCs, we all love product. I mean, especially in the crypto industry, most of us, I think all of us here are passionate about this industry, and we love the product. So it's something that we of course are passionate about. However, don't talk about it too much because the truth is, our decision. Even though we might love your product and think that wow, this is the future, we also know that we're not that smart, and that ultimately the market is the one that decides. So what we'll be asking for is, show me something that proves me that the market actually agrees with your product, what you're doing. And that comes with projections, comes with talking with customers, showing us that you actually have some interest for your product. I mean, that's what I would focus mainly in your pitches, is show me there is some interest from the market.
All right, maybe the last question.
My question is, blockchain modularity and modular approach is pretty much emerging. So this kind of, instead of monolithic view trying to solve everything on one chain, some others specifying different layers in the modular stack. Are you looking into, as VCs, looking into that technology also on the DeFi, from the DeFi perspective, or into investing into separate layers and innovation which specify in this modular stack? That's a no.
Well, if you looking at the Web3 stack completely, it makes sense to invest on every layer. Something we think, and that is maybe a question to combine here, is something to avoid as well, is this question token versus equity, right? On the pure infrastructure layer, it's pretty clear, okay, it's decentralized, you need a token, but we've seen so many projects which have lost focus, just raising a token on where it's not necessary, where you could have raised an equity. So that's an easy mistake you can do, and the higher you move towards probably the application layer, a rule of thumb would be the less likely you need a token. And maybe on that way as well, just to answer also that question, always be raising, always be talking to investors, and really find a focus. So try to find a product market fit where you build traction first before you switch on the growth button. So that is a very common mistake. I love this. I don't know if you know this value hacking before growth hacking from Mike Maples. If not, then you should definitely look at it. It's really not hiring thousands of salespeople before you haven't really figured out what to focus on, where the product market fit is. Did not so much answer your question, maybe a little bit, but mainly yours. But yeah, we invest alongside the entire stack.
Yeah, and so everybody got the book recommendation, so thanks for that. So please an applause to the panel, and looking forward to the year.